Okay, good evening or good day or good morning, whatever it is at the moment when you watch this video. Welcome to our boring lectures again, and this will be a short one because this is now the second half of the first chapter of value-added tax. We talk about the system of value-added tax, and we have already spoken about the first two neutralities, so neutrality in competition in general and neutrality in competition with regard to internal relations, so principle of the taxation in the country of destination. And now we have to speak about neutrality, which is necessary in the chain of entrepreneurs. So, yeah, let's again show what the problem is in order to make you understand what it's all about. Imagine we have in our thought experiment a product which is produced in 3 steps, and each step requires production cost of 100 each. Now, in case A, alternative A, the 3 entrepreneurs share the work one after another. So the first one does a bit of the total work, sells the result as an unfinished product to the next one in the chain. The next one adds 100 euro of work, then sells it to the last one in the chain, and the last one in the chain sells the finished computer and product to the customer. So, for example, a mine looks for iron as a raw material, steel factory produces steel from that iron, and the car factory turns the steel into a car. In the end, consumer buys the car. That, for example, is typical for the economy. And in case B, we have a kind of a monopolist or somebody who wants to do everything from the first step to the last. So the Scrooge McDuck approach, probably owning every enterprise, doing everything and selling directly to the consumer. Here we also have costs of 300 euro. And now this guy or girl has everything in his own hand or her own hand. 100, 100, 100, sells only once for 300 to the final consumer. Then what happens if we levy a VAT and don't do something special? Well, enterprise owner A has costs of 100. Let's add 20% because that's better than 19%, easier to calculate. 20% on top ends up with a price of 120. So 120, the product is sold to entrepreneur B. Entrepreneur B has own labor costs of 100 and has raw material bought from others for a price of 120, as you see here. The total costs are 220. Now 20% come on top, the value-added tax. The minimum price would be 264. Now sells for 264 to enterprise owner C. Own costs of C are again 100. The cost for the raw material bought from B is 264. Costs total is 364. VAT 20% again on top would be 72.80. So the price for which C can sell is 436.80. Now the competitor comes into play. This is a DD, let's say Scrooge McDuck, has 3 steps of production, does it all by himself, 100, 100, 100, no sale in between, no value-added tax in between. Total of cost is 300, 60 on top, 20%. Minimum price which can be asked is 360. So customer is now faced with 2 offers, 436.80 from entrepreneur C and from DD 360. It's clear for whom customer will decide. DD will survive and the chain of entrepreneurs will vanish from the market. So have a look. Here you see the chain of entrepreneurs has produced for exactly the same amount of costs like DD, but we eliminated A, B, and C as a chain of entrepreneurs from the market. So we created a kind of an artificial monopoly for DD, who is the most integrated factorer, no producer, will get rid of all the competitors. Distribution of labor doesn't pay off anymore. That is a bit strange for a tax system, and we should very thoroughly think if we really want that. So think about that. If our first interim result, if an indirect tax like value-added tax is levied on every stage within the chain of entrepreneurs, this will create an artificial increase of the value-added tax. It accumulates more and more, and it creates an artificial advantage in competition for those who do everything on their own. So this would cause in the long run all the firms to merge, to integrate into bigger entities throughout the line of production is probably not the best aim of economic policy, um, to artificially concentrate all economic power in the hands of very few institutions. So what would that mean if even the big firm is less competitive, less effective than the competitors? Let's again see that too. Imagine now DD needs 110 per step of production, whereas A, B, and C are slim, effective, and can produce every step for 100. So they should be better off and they should be preferred by the consumer. But what happens? A has again 100 cost, 20 VAT, can offer for 120. B 100 own costs, raw material 120, 220 total costs, 44 come on top, price 264, just as before, everything the same. C ends up with 436.80 as potential price. Now DD is less effective, pays cost of 110, 110, 110, total cost 330. Value added tax 60% on top would be 66. DD is still cheaper than the competitor. So DD here would push the ABC chain of entrepreneurs out of the market, although they can produce more effectively. And that's definitively not what a value-added tax system or any tax should do. Here you exclude the people who don't waste from the market. No, definitively no. So we need to react. The reason here is that the value-added tax in the chain of entrepreneurs has been taken several times. So that was the reason why it went up more and more. And if you add up all the amount of value-added tax which has been collected through the chain of entrepreneurs, that was considerably more than we demanded from DD, and that should not be. So we need a mechanism to avoid such a cumulative effect of value-added tax. First alternative, what we can do, most simple idea. We just say, okay, A and B are freed from VAT. We only take VAT at the last step, so when the sale to the consumer happens. Then we only have 100, 200 less without VAT. C can buy for 200, adds own cost of 300, has a total cost of 300. 60 on top is equally good as DD. But the problem here is a practical one. When somebody, for example, if you are entrepreneur A and somebody enters your shop, how can you be sure that this person is a consumer or not? Or better, if that person says, I am B, I am an entrepreneur, how do you know that's true? could perhaps try to waterboard and torture B until B admits the murder of John F. Kennedy, and then probably immediately afterwards, you could ask them, are you really an entrepreneur? And then probably you get the truth. Is a bit harsh, endangers a bit the customer-seller relationship. And imagine even if B is an entrepreneur, B also is a private person. So B could also buy something for private usage. And that is absolutely not to be checked in a reasonable and reliable way by A. So if you set up a system where A only has to charge, but then has to charge if A sells to consumer, that's absolutely not workable in practice. So what else can you do? And there was a second approach developed. The VAT is levied on every level of the chain. So every sale is just brutally charged with VAT, so A has no problem. Whoever enters the shop will be charged with VAT. A always sells at the gross price. But now the trick is, whenever the buyer is an enterprise owner and uses the stuff for the enterprise, the fiscal office pays back the value-added tax in the price to that buyer. So it's a kind of ping-pong approach. Ping means tax goes to fiscal office, pong, tax goes back. This sounds a bit strange, but if you compare it with the other alternative, A has to find out what the customer is going to do with the stuff. That's perhaps simpler. And the fiscal authorities, in contrast to A, the fiscal authorities can even later check what B did with the material which he bought, because the fiscal authorities have the possibility to go there, check the books, and ask the right question. They have an enormous potential for controlling matters and finding out what really happened. And if now B claimed the VAT refund for the input without justification, B can even be punished by the fiscal administration for tax fraud and the fiscal authorities can even very well enforce the correct payment. So this ping-pong approach is far better. And so how would it work? Now in the center of all what happens is the fiscal office or the fiscal authorities. Now entrepreneur A begins producing for 100, adding 20 VAT on top. Now the price which A charges to everybody is 120. Now the 20 go to the fiscal authorities as value-added tax on the output of this month, and the goods are sold to B. Now B begins to calculate. My own labor costs are 100. The input which I bought has cost me 120, but 20 I will get back from the fiscal office. So that lowers my cost, because a cost which is refunded to you is not cost anymore. You don't need to cover that by the price. So total of my costs, says B, is now lowered to 200. So I can sell for a net price of 200. I add 40 for the VAT on top. And so my price will be 240. And I see I even forgot a German word here on the slide. Preisforderung is simply price. So he gives these 40 to the fiscal office again. Fiscal office says, welcome. Nice to have that money. And they get that at the end of the month. B sells to C. And C now makes his calculation. My own labor cost 100. I paid for the raw material which I bought from B 240, but 40 is an amount which I get back. So my costs are lowered to 300 in the total. and 20 come on top, 60. So the minimum price for which I can offer to the customer is now 360. And surprise, this is now exactly the price which DD could offer under the same circumstances. So here you see we have achieved neutrality, and we don't kill off the chain of entrepreneurs here by the VAT system. And if you look to the economic consequences, because of that, tax goes to the fiscal office, tax goes back to the next entrepreneur. Because of that ping pong mechanism, in the end, only the tax which is charged to the final consumer stays definitive, because the final consumer cannot bring forward, I bought this for my enterprise and I used it for enterprise purposes. So final consumer stays and has to bear the tax burden in the price. Well, this is a very ingenious and clever mechanism how you can, although life is so complicated, you can ensure that the VAT is only paid definitively at the end of the chain, and so that all are treated equally, irrespective of how long or short the chain of entrepreneurs is, from the raw production of the raw materials to the last step of production, for example, if it's a rocket which goes to the moon. No problems. Great under that aspect. And really vital for the functioning of a value-added tax system. Some 60 or 70 years ago, these systems did not yet exist. There you had grave distortions in the chain of entrepreneurs, which usually had then to be corrected by refunds or subsidies, which had to be estimated, and that is always a bad thing. Now, when we accept that we have to design a value-added tax system this way, then automatically the next step comes. That is a need for control, because the system will suffer from some practice problems. The first thing is, when I say experts are tax-free, there is a natural temptation for some entrepreneurs to say that, okay, well, then everything I ever bought and which I sold was evidently exports. All my customers were Russians, Chinese, South Africans, because otherwise I would have to pay VAT and I don't want to. So people would lie, lie, and lie. So the better your liability, the lower your liability to the fiscal office from VAT would be, and that can't be. So you need controls. How can you check that an expert is really an expert? And the answer is, you need a border control. You need to demand from the seller or from the customer a proof from the border control authorities, so from the customs duties officers, that this good reached the border and then left the country and can never come back undetected into your own market. So that is vital. Border controls are necessary for such a system. Otherwise, the whole thing would break down. Because otherwise, naturally, clever businessmen or businesswomen would naturally pretend that they exported much of their products, and so would in reality sell their products somewhere completely untaxed with VAT, and so they could always outbid, undercut is probably the frequent word, they could always be cheaper than their competitors. Their legal and honest competitors would go bankrupt in the long run, because customers always buy there where it's so considerably cheaper. And so you would just kill your honest part of the business world by this system. So you absolutely need a control at the border. By the way, that doesn't cause additional costs because you already needed that border control personnel, because everything which crosses the border and comes into your country must be taxed. Otherwise, your market would break down because of the untaxed foreign goods which enter your territory. So you already have a border control for other reasons. And then when you decide for such an input refund system, that brings along another control necessity. Yeah, it's a bit more difficult to explain, because now what do you do as fiscal office if business owner B says, well, I bought material from A and there was VAT of 20 contained in the price? Then you naturally say, everybody can say that. Do you have proofs? So you need to agree on mechanisms how the business people can prove that they paid VAT, which was included in the price of products or services which they bought for production. So proofs must be documents. So these documents can only be invoices, which say what you bought and how the price was calculated. So net price plus VAT is gross price. So A must confirm in the invoice that the price contains VAT and how much that is. Then B can use this document as a proof to the fiscal office. So the invoice of A is a kind of check which B can present to the fiscal office. Now, what happens with a check to the bank? Well, you can falsify it. There is a certain temptation. And so if an invoice for a thing which you bought has virtually the function of a check, which you only need to present to the fiscal office if you are an entrepreneur, then naturally these checks are heavily risky or heavily under the temptation to get falsified. So what can the fiscal authorities do? Invoices so are dangerous like hell. You must check their authenticity definitively. And indeed, that is a big surprise. After the VAT systems were introduced, some people immediately began to falsify input invoices, present them with a plausible story to the fiscal offices, and lowered their own tax burden considerably. So naturally, that can't be. It's really a hobby of some parts of the population to pretend that input was paid for and that input was charged with VAT, and then to try to claim the refund. So you must demand from B that invoices are there, and you must be able to verify if these invoices are correct, if they are not falsified. Then naturally people began to develop other tax fraudulent models. For example, A just got an invoice from somebody called X or so, and now the invoice was correct. X exists, but X now doesn't pay the VAT to the fiscal office. When it comes to the moment when X has to pay, X just vanishes. Now you can't accuse B of that if you can't prove that B didn't know that. So problem is, here the fiscal office has to pay out the VAT, but doesn't get it from the first in the chain. There are numerous fraud models, and so the people got more and more inventive in that area, and so more and more conditions were demanded to be fulfilled in order to be able to check if an invoice is correct, if the person who issued the invoice is really existing, if that person really pays the taxes, if there might be a fraud behind, if the service or the good which is named on the invoice is really the good which was delivered. Imagine, for example, you are going to buy a book, let's say Harry Potter parts 1 to 35. And now, naturally, this is for your private consumer. But then you ask the book trader, could you please write another title on the invoice so that I can show it to the fiscal office and get the input VAT back? So it must be possible to check these things. So more and more requirements were developed, and today you have a big list of things which must be on an invoice. In the German VAT Act, in the Umsatzsteuergesetz, you find first a list of, I believe, in the meantime, 10 necessary pieces of information which must be on every invoice, and an additional paragraph with even more information which is necessary in certain special cases. It's the same with a check on the bank, drawn on the bank. Naturally, the bank also needs a huge mass of information to check the authenticity. There must be your bank account number on the check, and here you must name your VAT identification number or your taxpayer's identification number on an invoice, and other things, additional information which the fiscal authorities need in order to be able to check if everything with that invoice can be correct and is correct. After more and more requirements came into play, the EU states even agreed that a certain minimum amount which must be contained in an invoice was harmonized. There are still some options left over to the member states where they can choose if they demand that additional information or not. But a basic core of information is really demanded everywhere in the European Union on each invoice. And so if one of these requirements is missing or wrong on the invoice has the same quality as a check drawn on a bank where the signature or a date or something else is missing. The bank will not pay. And so the same is here. If you present an invoice as a document to prove an input refund claim, and a small detail which is required is missing on that invoice document, then you lost or you lose your input claim. If you even state, I have an input refund claim of, let's say, 2 million, and then one checks the invoice and one of the necessary details is missing, then you even have a bigger problem. First, you have to hand them back the money, naturally. And second, they will read you aloud that you made a wrong statement in a tax declaration. So wrong information to the fiscal office because you said I have a correct invoice and I have a refund claim. Second, that wrong information led to a financial advantage, to a tax advantage in your favor. And third, you did it on purpose because everybody knows that you have to check an invoice for every detail. And if you didn't do this, this was either extremely careless or it was done on purpose. So it would be tax fraud, criminal investigations would be begun, and with an amount of 2 million, it would be rather likely that you have a certain chance to end up some years of your life in prison. So not recommendable. There you must be highly cautious. So what happens now if an invoice is issued somewhere wrongly? Some necessary detail is missing. or somebody overstated the VAT which was due. First, if anything is wrong with the invoice or with the contents of the invoice, so even if the case was treated wrongly, you can't directly see it from the invoice, then the recipient has no claim to an input tax refund. For example, if somebody confirms VAT in a price but is not able to confirm VAT in a price, for example, because that person is not an enterprise owner, then the whole VAT is just a sham, not refundable. And on the other side, the same thing happens, which happens to a person which writes out a check, which is drawn in a bank and is not correct. You have to pay that money to the bank if the bank demands that, because that's your problem. So if you confirm either VAT and you are not entitled to do so, or if you by error confirm more VAT than is due, you have to pay at least the amount which you confirm in the invoice to the fiscal office under all circumstances, just because of the mistake. And at the same time, nevertheless, the recipient of the invoice can only claim the correct part of the VAT, which is still confirmed in the invoice, so not the erroneous excessive amount. And so both get the maximum punishment. The person who writes too much VAT on an invoice has to pay the full amount. The person who accepts such an invoice and pays it by error without seeing that the VAT treatment was wrong loses the refund claim for all the exceeding amount and can only claim the correct legal amount. So if something goes wrong, the fiscal authorities can recover the money or claim the money from both parties involved, and that stays the same or stays unchanged until the person who wrote out the invoice corrects the error and replaces the wrong invoice by a new one. Sometimes that can't happen. For example, if the person was a GmbH and has become bankrupt in the meantime, or a sole trader has died, people who are dead or GmbHs who do no longer exist have certain difficulties in correcting an invoice which they wrote 3 years ago or so. So then your money is definitively lost. Is an enormous risk. The European Court of Justice has in the meantime said that the member states must offer a possibility to correct a wrong invoice in all circumstances, but only under the restriction that the parties involved can prove that no damage happened. Usually the requirements can be different. For example, if it was an excusable error, the correction of an invoice is easier than in cases where it was an unexcusable error or even an attempted tax fraud. But in principle, as long as such a correction of the tax declaration of the invoice document was not made, you have to pay. Especially bad is that if you sell to private customers, consumers which take the cash receipt from the cash desk and go away, and you never find out who got that document. You can't call it back, you can't correct it, and then maximum catastrophe, you can't get rid of the wrong tax which is too high. On the other hand, naturally, if you charge somebody an amount of VAT which is too low, then the fiscal authorities will demand the correct legal amount which is higher, naturally. So whenever you make a mistake, you are lost your financial grave consequences. And imagine how and where that might happen. Supplier G issues an invoice for customer C for a delivery of chocolate. And €1,000 evidently a big amount of chocolate, plus 190 euro VAT, 1190. Now chocolate is subject not to 19%, but to a special reduced rate of 7%. G does not seem to know that. Consequently, the correct VAT is only 7%, therefore the price should have been 1070 and the VAT included would only have been 70. But now 1190 was paid. That was definitively the gross price. And under the law for chocolate, the gross price is 107% of the net price. So the correct VAT included in that amount can only be 7% out of 107% of the amount which was definitively and really paid, 1190. This is a bit more than 70, but this is 77.85 euro, and the net price is then 1112.15. Now you might ask, why not only 70? The answer is because by error the other part paid more than 1,000. Higher gross price, higher net price automatically if the rate was not 19%. Okay. Now our supplier confirmed VAT of 190. So the supplier has under all circumstances to pay the full 190. But so the correct amount 77 and the overcharged amount 112 and some cents. The buyer, on the other hand, is only allowed to draw input tax or to claim the input tax refund for the correct amount of VAT contained in that price. Because you are only allowed to claim the input VAT which you paid for deliveries or services made to your enterprise, but not for booking errors. And this is cleverly written between the lines in the Tax Act, but all the courts in Europe agree on that. You don't get a refund for erroneous VAT. So in that case, the one has to pay 112 euro more to the fiscal office than needed, and the other, the buyer, doesn't get the refund for that. So both lose 112.15 each until somebody managed to correct that invoice. There can be many other further examples where false invoices could be issued. For example, in an international context, you might mix up the countries to whom you have to pay. I know from an example which somebody told me, there a German firm built some hotel buildings for another German firm. So let's say 10 million, and naturally they charged German VAT. We are a German firm, you are a German firm, let's say 1.9 million VAT on the invoice, and the recipient took the invoice and claimed input VAT refund of 1.9 million. Later tax inspection came and said, okay, we have a question. The hotels which you built, they were in Spain. And now what do you think? If you build a hotel building in Spain, the country of destination is probably Spain. So the VAT for that transaction goes to Spain. And now if you charge German VAT on an invoice, is that Spain? No. So you mixed up the countries, idiots. So the complete 19% German VAT was overstated. So that was excessive VAT because you owed Germany 0 VAT. But you confirmed it in an invoice, so you had to pay it to the fiscal authorities. On the other hand, the complete correct VAT, which was due to Spain, was unpaid still, so they could still claim it, and naturally, because you were delayed in payment, probably plus interest. Now, the buyer of the hotel buildings had claimed the German VAT refund from, let's say, 2 or 3 years ago, and so that buyer had to give back the erroneous refund claim to Germany, let's say 1.9 million, naturally, because you had taken the money at the time and only gave it back 2 or 3 years later, you have to pay enormous interest amounts for the time in between. So making a small little mistake in the area of VAT can have enormous and drastic consequences. There have already been firms, and that is not so rare, which went bankrupt over the financial consequences of a booking error concerning wrong dealings with VAT. So what we can already sum up here is, in principle, VAT is a very convenient tax if you are a business owner and have to do with business customers. You don't need to worry about it if everything goes correct, because you pay, customer gets it back. You usually don't even think about VAT when you negotiate prices, because your customer is only interested in the net price. Customer knows the VAT will be paid back to me if I'm a business owner and buy from a business. So far, so good. So many businesses who only produce for other businesses usually don't bother to think about VAT, but from the moment on, when a small detail goes wrong, the whole thing explodes like a nuclear bomb that can destroy the whole enterprise. I once came across somebody who was well familiar with statistics. He or she, don't remember who it was, told me the average amount which a special audit for VAT claims per day of inspection. So the average amount of mistakes which a VAT auditor finds per day of work in a firm was at that time 30,000 euro. So just checking input and output VAT invoices, mostly wrongly accepted input VAT invoices, leads to an average damage of 30,000 euro per day of inspection per person coming and showing up. That means if you get a VAT inspection by the fiscal authorities and they come with 2 people for 5 days or so, then if you have to pay them back less than 300,000 euro, you are already better than the average. And this, ladies and gentlemen, should be a strong motivation for you to deal with VAT cases absolutely meticulously, so perfectly. You must be able to check not only the correctness of the VAT treatment of everything which you charge others, but also to check if all the VAT invoices which come in to your enterprise have been dealt with correctly. If they are correct in on the formal aspects, checklists for all the necessary details on the invoice, and if they can be correct from the contents. So if the other party has treated the VAT situation correctly. If you renounce on that, there will be a big amount of happiness, but not in your face, in the face of the fiscal inspection when they come. Probably, if they smile to you and just without words take a bottle of champagne and open it, and you know, okay, it was you who made the promotion of that inspector to a better job possible, and you will regret it. Okay, good. I think that should be enough. Yes, the second chapter is going to come another time. Okay, thanks for listening. I hope you found it interesting. If so, be proud of yourself. If not, it was perhaps then my fault. Thank you very much for listening. See you again next